What a week it's been for the equity markets and banks in particular. Last Friday, due to a sudden increase in deposit outflows and a failed attempt to raise capital, Silicon Valley Bank was closed by US regulators. Now, this marked the largest bank failure since the 2008 financial crisis. SVB's collapse led to a decline in global banking and financial stocks. India too hasn't been immune to this shock. So what really happened with SVB? How did US regulators react and why? Who is to blame for this crisis? What implications will it have on Indian banks and for the Indian markets? Let's uncover the details in this episode of Informed Investor. Let's begin. You're watching Informed Investor at the Third Empire and initiated by ResearchAndRanking. Silicon Valley Bank, established in 1983, was the 16th biggest bank in America. Before collapsing, it used to provide services to nearly half of the venture-backed technology companies in the US. Now, right before the crisis, Silicon Valley Bank actually made Forbes' annual list of America's best banks. So what exactly went wrong with such an important bank? The short answer is Silicon Valley Bank did not have enough cash to pay its depositors, so California regulators closed the bank. Now let me break this down for you. But first, let's understand how a bank works. Now, banks take deposits from customers like you and I and pay us a low rate of interest. These deposits act as a source of funds for the bank to lend out to others who need to borrow money for various purposes. Now, these loans are typically given out at a higher rate of interest than what the bank pays to its depositors, allowing the bank to earn a profit in the process. Now, this process is called lending, and it's one of the primary ways in which banks make money. However, banks don't just stop at lending. They also invest some of the money they receive from deposits, like things, into bonds. Now, although these investments may not earn as much money as lending does, they can be sold quickly in case of an emergency. And of course, banks also keep a portion of the money they receive in cash to be on the safe side. Now, this reserve of cash acts as a buffer against unforeseen events that could put the bank's stability at risk. So there you have it. Banks make money by taking deposits from customers, lending most of these funds out to the others, investing some of the money in things like bonds, and keeping a reserve of cash on hand. Now, it's a balancing act that allows banks to generate profits while ensuring the safety of their customers' deposits. But with Silicon Valley Bank, things are a little different. First, let's take a look at the SVB's business model. Silicon Valley Bank gained a reputation as a trendsetter for being one of the first banks to concentrate on startups and VCs. Its area of expertise was in receiving deposits from startups and giving loans to companies that finance startups or directly finance startup businesses. As a result, many startup businesses kept their funds as deposits with SVB. In 2020, the COVID-19 pandemic caused a lot of money to flow into financial markets. Central banks around the world, including the US Federal Reserve, implemented measures to stabilize the market and the economy during the pandemic. The Fed in particular cut interest rates to near zero to keep money flowing through the economy. Now, this flood of liquidity created an environment where investors were flush with cash and eager to invest in high growth opportunities. Startups in particular saw a surge in activities as investors sought out companies that could offer higher returns. On the back of this, Silicon Valley Bank, which had positioned itself as the bank for the venture capital market, enjoyed a significant inflow of deposits. In fact, from 2019 to late 2022, SVB's total deposits more than tripled, growing from $61.7 billion in 2019 to $173 billion in December 2022. But underneath the hood, the reality was that SVB had received so much deposit during the last few years that it wasn't able to loan them out fast enough. Now, deposits are a bank's liabilities, and they owe it back to the depositors at some point in time. Now remember, banks don't typically hold all customer deposits in cash. They utilize deposits to make loans or purchase historically stable securities like treasury or mortgage-backed securities with these customer deposits. Now, during the period of zero interest rates, SVB utilized a significant portion of their deposits to invest in longer-term US government bonds and mortgage-backed securities rather than putting these funds in shorter-term bonds that are less affected by interest rates. Now, this included the purchase of over $80 billion worth of mortgage-backed securities for their hold-to-maturity portfolio, with almost 97% of these securities having a duration of 10 plus years. In fact, SVB had a much larger investment portfolio as a percentage of their total asset, with 57% of their assets being invested, and a substantial 78% of their investment portfolio being in mortgage-backed securities, while other major banks such as Citi or JP Morgan had around 30% invested in MBS. Now, this wasn't a totally reckless decision. None of these assets it bought were at risk of defaulting. But we all know that the Federal Reserve has been hiking interest rates aggressively to tame inflation. So this exposed SVB to a lot of interest rate risk, because when interest rates rise, bond prices fall. Now that interest rates have gone up almost 500 basis points, these bonds are down in price and hence eroded the value of SVB's bond portfolio. At the same time, venture capital began drying up, forcing startups to withdraw the funds held by SVB. Since the bank didn't have enough cash in hand, it had to sell some of its bonds at a loss to repay depositors. Now remember, the bank was already sitting on a mountain of unrealized losses in bonds just as the pace of customer withdrawals was escalating. Now they then decided to sell a chunk of their portfolio assets at a loss and do a capital raise to account for the funding gap. Like we mentioned earlier, SVB has a different customer base compared to regular banks. It largely caters to startup tech firms. Now, in the tech industries, investors tend to follow each other's investment choices. They communicate with each other both online and offline. And when this community became concerned about SVB's financial well-being, it created an ideal situation for a bank run. In fact, some venture capital firms, for example, Peter Thiel's Founders Fund, encouraged their portfolio companies to move their money out of SVB due to concerns about its financial stabilities. Now, companies and people with money in SVB moved to pull it out. When SVB wasn't able to raise the cash it needed to cover the outflows, this prompted the regulators to step in and close the bank. So this was exactly what went wrong with SVB. To sum it up, a part of SVB's problem was that it actually lent out too little. Second, it ran a concentration risk, with most of the deposits coming from VC-funded startups and crypto companies. Third, it channeled most of its deposits into investments with a long-term horizon in an era of rising interest rate regime. But what SVB did wrong was it didn't hedge the interest rate risk. It was not applying basic risk management practices and exposing its investors and deposits to a large amount of risk. In fact, the company didn't have a chief risk officer for several months. In some ways, the crisis was building up for some time behind the scenes. Ever since the crisis at Silicon Valley Bank came out in public last week, and many Indian startups also got affected, questions have been raised on whether there could be any impact on Indian banks as well. Now, let's explore the impact of the SVB crisis on the Indian financial sector from two perspectives: objective and sentimental. As the saying goes, when the US sneezes, the world catches a cold. And that's what's precisely occurred when Indian banks experienced a sell-off in recent sessions. Nifty Bank's index has dropped by about 4% due to the Silicon Valley Bank crisis. Now, from a sentimental standpoint, the SVB crisis has dealt a blow to Indian banks, and we may see increased volatility in the near term due to fear about the global financial system. The startup ecosystem could also be impacted. However, let's take a step back and assess the crisis impact on the Indian banking system objectively. Just to put it out there, during the global financial crisis, triggered by Lehman's collapse in 2008, India's domestic banks demonstrated resilience and strength due to their sound and stringent regulatory practices. Now, will a similar event occur in Indian banks such as the SVB crisis? It is highly unlikely. The Reserve Bank of India, first of all, won't allow banks to invest such a significant amount of money in vulnerable securities. According to a Jefferies report, unlike SVB, Indian banks don't hold a majority of their assets in the form of bonds. Loans make up about 65% of the assets for Indian banks, and investments contribute only about 25%. Moreover, government securities account for 80% of the total investments made by banks in securities. Also, as per RBI rules, banks have to maintain 18% of their deposits in the form of SLR bonds. This means if a bank has total deposits of rupees 100 crore, it has to invest rupees 18 crore in government banks or other approved securities. Similarly, banks also have to maintain a certain percentage of their deposits in the form of cash reserves with the RBI, which is known as the cash reserve ratio. As of March 2023, CRR is 4.5%, while in the US, the reserve ratio is almost zero. Now, this shows that we have very strong reserve ratio requirements, and in times like this is truly a blessing in disguise for the Indian banking system. Now, we also saw how SVB mostly caters to VCs and PEs. Venture capital funds are generally in need of constant cash, and the deposit to withdrawal ratio are quite unpredictable. The bank had little to none retail depositors. Retail depositors generally tend to keep their deposits for longer tenures and have a more predictable patterns of withdrawal. In India, the Jeffrey analysis further showed that while 63% of deposits come from households that are typically stickier, only 22% comes from corporates, while government and NRIs accounted for 9% and 6% respectively. So we see more of a diversified base in the Indian banking system. Now, in RBI's financial stability report released in December, RBI's stress test found that banks would be able to withstand severe stress. It found that even if customers withdraw 15% of uninsured deposit, liquid assets equivalent to 12.2% of total assets would be available. Now, the Indian banking system is not significantly affected by the failure of the SVB because of their better asset liability management and limited to no involvement with the Silicon Valley Bank. Furthermore, Indian banks typically do not finance startups, reducing the potential impact on them. Now, Jefferies and Macquarie, two major players in the investment and financial service industry, have also shown great faith in Indian banks amidst the SVB crisis. They have cited reasons such as the bank's reliance on local deposits, investments in government bonds, and significant cash reserves as reasons for their optimism. Macquarie in particular expects the Indian banks to continue experiencing low credit costs, leading to a multi-year high returns on assets and upgrade in earnings per share. Now, this positive outlook suggests that the Indian banking sector is well positioned for growth and success in the years to come. Now, to conclude, amid all the doom and gloom in global banks, banks in India are relatively stable. It isn't like we've not had our share of bank failures, and it's not like we won't see challenges arise with our banking system. But RBI is one of the most conservative central banks in the world. The Indian banking system is more insulated and regulated under the supervision of the RBI. And at times like these, a vigilant central bank is all we need. This was our attempt to break down the Silicon Valley Bank crisis and its impact on the Indian banking system. This is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.